Welcome to the weekly update, where I'll go over the action in the market for the week of July 3rd through the 7th, and then we'll see how things look for the week of July 10th through the 14th. We had another down week. It was a holiday shortened week because of the 4th of July, and volume was below average. We spent the earlier part of the week pretty much chopping sideways. Then we started to go down. Then it looked like on Friday we were going to recoup some of those losses, only to give them up right before the market closed. We're still looking positive overall, but on the daily charts, we're above support, and so far that is holding. If we start to break down below that, that could also come through and influence the weekly charts as well. Before we get started, I have a few things to bring to your attention. There is a PDF of all the slides that I use in the videos that's available in the description below this video. I do also have a condensed version of the daily video. I know a lot of you are busy. Usually the daily videos are about 30 minutes or so each. Well, what I've done is I try to take the important points from that video and make another video that's about maybe 8 to 10 to 12 minutes long. Maybe some of you would find that useful. I also have a private Facebook group that you're welcome to join. I will be putting up a poll for this week after I get done recording and posting this video. And also, I keep a real close watch on YouTube comments. Most of the time, it's not a problem. I'm just trying to keep the bot comments and the crap comments out of there because I want this to be a free place where people can express themselves. Even if you disagree with me, that's fine. Just try to keep it civil because we can have good, healthy back and forth, and that's no problem. If you don't feel comfortable doing that, at the end of each video, I give you an email address where you can send a note to me privately if you'd rather do it that way. And I also post the videos on Rumble. Here is the channel. In case you can't find me on YouTube, I also have a Rumble channel. All right, let's go back and talk about what happened. For the week, we were down 1.16%. Volume was below average. Part of that had to do with the holiday. And the technicals are still positive for right now, and I'll go through all the charts. The markets are still really fixated on inflation and interest rates, which a week ago it was looking like maybe we're more in Goldilocks territory where everything's going to be okay. Well, we started to see some international economic reports that were released that were weaker than expected. Some reports started coming out in the US, and now the market's going, maybe we need to start worrying about this again. We're also keeping an eye on the geopolitical events. A week ago, there was a situation in Russia that I think was supposed to be some kind of a coup. It kind of ended as quickly as it started. Don't really know where that's at right now, but we'll keep an eye on the information that's coming out of there, if we can even trust any of the information, because that may come over at some point and have an impact on the market. And then we're getting started again with earnings season coming up as well. Our trend is still getting stronger, and we have a positive trend on the weekly chart. We're still strong on the daily chart, but the ADX is dropping below the moving average, which is now suggesting that the trend is starting to weaken. Here is a look at all the different indexes. The Dow was down 2%, the NASDAQ down 0.9%, the S&P down 1.2%, and the small caps were down 1.3%. So for the week, here are some bullet points just to go through. Volume and price action were slow on Monday because we closed early that day and we had the holiday on Tuesday. Then geopolitical concerns also started to rekindle growth concerns. Now that economic data that was coming out of China as well as out of Europe was weaker than expected, the US came out and said, well, we're going to try to restrict China's access to cloud computing. That could have a real impact on the tech sector. And then China came out and said, well, we're going to make it where you have to ask for permission to take our gallium and our germanium. Now, germanium doesn't come from Germany. Gallium is used in semiconductor production, and germanium is used for night vision goggles and some high-tech gadgets. And China's the biggest producer of those, and so not to have access to those could really be influential. The FOMC meeting minutes did come out. This was for the meeting of June 13th and 14th. There really wasn't any surprises in there, so the market didn't really react all that much. Then later in the week, we started to see interest rates really shooting back up, and that became a concern for the markets. That was really what pulled stocks down from higher levels. The ADP employment change did come out, and it was almost double what they had expected it to be. That was on Thursday, but then on Friday, we came out with the employment situation report, and it wasn't quite as strong, and the market was a little bit more accepting of that report. Let's go back and look at the poll results for the latest poll, where the first question is, the S&P is short-term overbought. This is as of a week ago. Do you feel this will result in a pullback before going higher, or are we going to actually develop into a downtrend? It was pretty much across the board. 54% thought it was going to be a pullback. 46% thought that we were going to turn into a downtrend. Then looking down over here, results were released showing all banks successfully passing a stress test. Does this give you confidence in the banking system? 80% said no, 20% said yes. My personal comment is, well, Silicon Valley Bank passed their stress test, and look what happened to them. Then over on the right-hand side, there has been a gradual shift from a global economic slowdown a week ago to feeling the economy may experience a soft landing. Do you feel that we will have a soft landing? 60% said yes, 40% no. That's shifting all the time. We're actually going back more towards the other direction now. Do you feel the S&P will follow historical patterns starting in July, where we start the month strong and then we see weakness later in the month? 88% said yes and 13% no. Now we go in and look at some Isabel Net blog charts. The first one here is inflation has accounted for 3/4 of the earnings per share growth, where we are seeing earnings per share going up, and we're seeing estimates still really going up as well. But in real terms, that means we take inflation into account. It has been going up, but a lot lower than it may look otherwise. Then we look at the Fed funds futures curve, where a week ago we were at this purple line, and because of the stronger economic reports that have been coming out, we've jumped up to this blue line looking forward. What has been the weekly equity fund flows? The blue bars here, that's what happens on a weekly basis, and the yellow line is the 12-week moving average, where we're starting to see money coming out of stocks, and we're starting to see the trend roll over as well. Then earnings estimates, and I put this red arrow on here. No matter what seems to happen these days, whether you're Morgan Stanley or the whole consensus of economists and analysts out there, they still suggest that earnings are going to rise going into 2025. What are the hot markets and what are the not hot markets right now? Japan seems to be pretty hot, followed by high yield markets. Those are junk bonds. And then looking at the bottom, we have TIPS. Now, these are inflation adjusted shorter term bonds. And you want to get those when you're afraid interest rates are going to go up, because once it expires or matures, you roll over into the next one. And if interest rates are going up, you get a higher return. When you're not as fearful of interest rates going up, you don't get into TIPS. You get into regular bonds and maybe further out in the maturity, and that rate will last a longer period of time. And we see a lot of money coming out of that. We also are seeing some real weakness in utilities. We're seeing weakness in financials, but at the same time, about a week or so ago, I showed a chart suggesting that there's a lot of insider buying going on in the financial sector. We look at employees and temporary health services. We're starting to drop down below this red line, and when that's happened before, that typically will precede a recession. Then we look at the S&P tech relative, where tech is really outperforming the S&P, and I have other charts that I go through in the intermarket analysis chart that kind of confirm that. And then we look at the TIPS, that's the black line here. So it's going down, down, down. And then we have the purple line, which is the forward-looking PE ratio, and we're seeing that there's a really wide gap between the two. They tend to move in the same general direction, and even though they're on different scales, they have a tendency to not get too far apart from each other. And there's a really wide spread right now, suggesting that either interest rates are going to have to go up, or the NASDAQ 100 may have to come down as far as their forward-looking PE ratio, which probably means prices will have to fall. Then we look at stocks have been historically strong late in the week. This is taking each day of the week so far and saying what are the best days. Monday, Thursday, and Friday tend to be positive, or Tuesday and Wednesday end up being negative. I have not been able to update the current market valuation charts. They weren't ready at the time I was ready to record this video, so I'll try to catch that in either the intermarket analysis video or in the deep dive video that I have yet to record. Getting into our charts and analysis. Here's the intraday chart going back to Monday, where we had a shortened day that day and we had an upward bias, but not a lot of volume. Then we were closed on Tuesday. When we opened on Wednesday, we gapped lower and then we're able to bounce back up and actually close off of the lows. Thursday was kind of the big down day. We really gapped lower and went all the way down below S3 and S4, which we rarely see. Now, these S levels and R levels that you see, On a 10-minute daily chart, they're calculated based on the previous day. Well, the range was so small on Wednesday that it didn't take us very much to get down to S3 or S4. Now, one thing that was encouraging is that once we hit the bottom, we were able to bounce up off of that, and we spent most of the rest of that session bouncing back up. The hope was that maybe it would carry through into Friday. Well, we jockeyed around a little bit, and then we did start to go higher, but then about halfway through the day, we hit a top and then started to come down. We ended up closing at the low for the day. So for the week, and this just goes over the last 4 trading days, all of the indexes ended up being negative, with the mid-caps being down the least and the Dow being down the most. When we go back to the beginning of the year, all of the indexes still continue to be positive, led by the NASDAQ 100 and then the NASDAQ. And then going back to the all-time high, all of the indexes are still negative. Looking at our different sectors, and again, this goes from Friday to Friday, but the 4th of July is not included in this. We had a down week, so I sort this according to what was down the most. We had healthcare, materials, and tech were down the most. We had one sector that ended up being up, and that was real estate, and it's really been getting hammered lately, so to have it be the only sector that ended up positive is kind of surprising. So we also look at the relative rotation graph. Think of this chart back to your geometry days, where the flat line here is the x-axis, and the up and down line is the y-axis. When we're in the right-hand corner, that's a plus plus, and that's as good as you can get. Well, we have discretionary and tech, which are green and actually showing some good action. Well, the communications sector, which had been in here, now it's starting to show some weakness. Now, when we drop below this line, we're above the y-axis, but we're below the x-axis. So this shows that things are getting weaker. When we get way down here into the lower left-hand corner, these are the things that are really lagging, and a lot of the sectors are really falling behind. We are seeing a little bit of a pickup in the financials, though. They're going from the lagging stage into improving. Then looking at the sectors for the week, all of the sectors ended up being down just when we take the 4 trading days of the past week. Going back to the beginning of the year, we have tech, communication, and discretionary doing the best. We have healthcare, utilities, and energy doing the worst. Back to the all-time high, energy is still in the lead, riding on the gains that it had back in 2022, followed by industrials, and then all of the other sectors are negative since the all-time high in early January 2022. Looking at sentiment, we're still extreme when we look at our gauge here, where we're at 78. We had gone a little bit higher than that, and we're starting to come back down. Here's the historical chart, where we got up to about 85, and now we're starting to drop back. This suggests that there's too many people that think the market's going to continue to go up, and it's probably due for at least some kind of a pullback. We also have the latest reading of the active asset managers, where they did show some improvement and we're back above 80, not necessarily getting an extreme reading. And then another chart of the same thing, where we are above 80. You could make a case to say maybe we're getting a little too exuberant here, but I tend to pay more attention to it when we get above 90. Looking at the Ridex bear bull ratio, where we are falling, folks are tending to get more bullish now than bearish, thinking that the market's going to go up rather than down. And then the latest reading from American Association of Individual Investors, it did show some improvement, because a week ago we had that really solid up Friday, but we're not necessarily extreme positive at this point. So we can still go with this unless we see this survey really start to go up and give us an extreme positive reading. Looking at the VIX, we did turn back up this past week with the line chart as well as the bar chart. And the Ulcer Index did increase just a little bit. There's still not a lot of fear in the market, but there's a little bit that's starting to creep back in. Looking at cash and then comparing it to the tech sector, the tech sector is doing better when we see this black line going down, and so that's actually positive for the market. When this turned negative was in 2022, when we went above all of these moving averages and above this Ichimoku cloud. Now we've been coming back down, so that is more positive. Looking at the economy, here's the latest reading from GDP Now, where the Atlanta Fed estimate is right around to a little bit higher than 2%. The top 10 economists have us up at about 2%, where the bottom 10 have us down around minus 0.5%. Then here's another look graphically, where we're still looking positive going forward with what they think GDP will be. Looking at the spread between risky bonds and not very risky bonds, if this ratio is really going up, that gets us concerned. This ratio continues to go down. Also looking at the National Financial Conditions Index, as long as we're below this black line, things are still okay. We also have bank tightening. This hasn't been updated in over a month, but banks are really tightening their standards for loaning out money. The real-time SOM rule recession indicator, we're still down around this black line. This was updated as of Friday. When we get real concerned is when this line goes above this red line, and we're far away from that. The smooth U.S. recession probabilities index, again, when we get above this red line, that's when we're concerned, and we're barely at the black line. The Brave Butters, Kelly, this is causing a little bit of concern. This is updated a little more regularly, where we are above the black line and increasing. So we want to keep an eye on that. Inflation, we started a new quarter, so the inflation nowcasting is still pretty much flat. Keeping an eye on the Fed, where are we as of Friday? There's a 93% chance that they're going to raise rates 25 basis points at the next meeting, which will be on July 26th. And then looking how this has changed, the dark blue area, that's where we're at right now. It's about the same as it was a day ago, a little bit lower a week ago, and quite a bit lower a month ago. For right now, that seems to be the consensus as to what will happen. Now, this can change. We still have a few weeks before that meeting, and all kinds of economic reports are going to come out, and this can easily shift very quickly. Looking at the Fed balance sheet, it is decreasing, like they said it would. This bump up was during the bank crisis, and now it's been continuing to decrease. Here's a year-over-year change, showing how the balance sheet is going down. Looking at our breadth, we're still positive. We're above the moving average based on price as well as volume. We're also seeing some improvement with the new highs, new lows. We're turning down a little bit with our 4-week average, and we're turning down a bit with our 10-week moving average. We saw on the daily chart some real improvement, but then this last week was so slow it kind of ruined our averages overall. The advanced decline ratio is still above 0 and ticked down just slightly. Accumulation distribution, as long as we're above this red line, that's more positive even though it declines slightly. Keeping an eye on our trend, we are seeing the ADX above the moving average and it's starting to go above 20. The green line is on top, so we default to positive even though the green line is coming down slightly. Our Arun indicator, when the green line is at the top, that means buyers are in control. We are seeing a bit of an increase in sellers. We were getting an extreme positive reading with this oscillator and now it's starting to drop back down. The mass index is not generating a signal right now. Some of our other charts, here's a daily chart, where one interesting thing about Thursday's action is that we came back down and filled the gap from last Thursday to Friday, and then this last Thursday to Friday, we were able to close that area in there. We're still above support right now. Then on the bottom, you can see where volume continues to be below average. We're still above the midpoint of the trend channel going back to 2009. The pivot points, we're still positive. We're above the monthly pivot point. We're still above the 50-period simple moving average. And the long-term trend continues to be positive. The McClellan oscillator has dropped below 0. That's slightly negative. And looking at our Swenlin trading oscillator, we're above 0 based on price and volume, although we did decline a bit based on price. The summation index, this is more positive. We're above 0 and advancing. We turned back up very slightly based on volume. The bullish percent index, and we're seeing almost this exact same reading on the daily chart. We're not extreme positive yet, and we are showing some improvement, suggesting that there's more internal strength inside the S&P. The PMO continues to be positive, and we're above 0 based on price and volume, even though we declined slightly with the volume. The PMO study, after getting an extreme positive reading, has been dropping back down. We're showing a bit of a decline with the buy signals, but we're still seeing the PMOs that are above 0 advancing. Looking at all of our oscillators, the short-term oscillators are positive, our intermediate-term oscillators are positive, and our long-term oscillators continue to be positive. We're seeing more mixed signals on the daily charts. A lot of them are turning down, and they had got to a pretty extreme positive reading, so that's a little bit of a concern. The Bollinger Bands, after giving us an extreme positive reading, has been dropping down when we use the percent B indicator. That's when we go outside of either the upper or lower Bollinger Band. The Chaikin money flow is still positive, and this tries to measure institutional buying or selling. As long as this is green and advancing, that is more positive. The Chaikin oscillator longer term, after giving us an extreme positive reading, continues to decline. The force index, even though it declined, is still above 0, so that's positive. The money flow indicator is now getting into an extreme positive reading. The rate of change going back 1 week, since we had the down week, we dropped below 0. Going back 50 weeks, we are more or less chopping sideways, but saw a little bit of a decline. and I've been showing this every day in the daily videos, where the daily chart has just crossed over positive, the weekly chart is just crossing over negative. Not quite sure what to make of that for right now. The RSI is above 50, even though it did decline slightly, so that's still more positive. The Stochk RSI, after being extreme positive, is now starting to drop back down. The Williams percent R is still extreme positive. The Vortex still has the green line on top and starting to get extreme, but the fact that the green line is on top is positive. The Ultimate Oscillator is still extreme positive and starting to come back down. The Copic Curve is still positive, even though it's beginning to roll over. And looking at our longer-term Fibonacci chart, we're above the moving averages and all the Fibonacci retracement level. Looking at our charts, the Heiken Ashi on the weekly chart is still positive. The Keigi is positive with a black line that's pointing up. The Renko continues to be positive, and the 3-line break is also still positive. We look at the two different things on this chart. We have the equivolume chart. When it's green and going up, that's positive. When it's red and going down, that's negative. The thicker this candle, the more volume went into that particular move. Then on the bottom is the ease of movement indicator. It tries to pick the path of least resistance. Is it to the upside or to the downside? Well, going back 1 week, it's still maintaining a positive stance. We're turning down a little bit when we go back 14 weeks. Point and figure chart, no changes here. We had a signal that was generated on May 15th, which is an ascending triple top breakout, but we have not seen any new X's or O's drawn in this chart as of late. Our different trading systems. The Elder Impulse system for the S&P is switched to neutral, but the Parabolic SAR system has the dots underneath, so that remains positive. Some broad market looks. Here's the S&P, which has been going up. The mid caps, which are showing a little bit more internal strength than what the index is showing, and the small caps have been lagging behind. The Dow continues to be in an uptrend. The NASDAQ is in an uptrend. The NASDAQ 100 is in an uptrend, and we're starting to come back to this previous high now, and we're having a hard time breaking through that. So if you want to watch things on a daily basis, be watching this previous high. The small caps are showing some improvement, but continue to be in a downtrend. Now, one caveat to tell you, on the daily chart, looking at the Russell 2000, which is a small cap index, we just had a recent golden cross on the daily chart. We're not seeing that on the S&P small cap index on the daily chart. So we're seeing a little bit of a discrepancy there. The mid caps are showing some improvement and are in an uptrend. The NYSE is continuing to be in an uptrend, as is the Wilshire. All stocks are still in an uptrend. The biggest software companies continue to be in an uptrend. The FANG index is still going up, and we're coming back to this previous high. Will we be able to break through that, or are we going to fall back? ARK is still looking more positive. We have a golden cross on the daily chart, and just a week ago we had a golden cross on the weekly chart. The bank index that we follow is looking more positive. The RSI is bouncing back up, and the MACD is trying to turn back more positive. The number of deposits that are going into banks is starting to see a little bit of an increase. And here's one interesting thing that we're following is the transports. You can't see it as well on this weekly chart, but we're coming back to a previous high. And when you take a ratio of the S&P and transports, when they're both really moving up, that can give some really good support to the S&P. So we're trying to see, can we break above this previous high and continue to go on with the transports? The utilities, on the other hand, are continuing to show weakness. Some broad market looks. The CRB index continues to be in a downtrend. Oil jumped up a little bit. We had been camped out around 70. We jumped up to 73.86. Copper is still bouncing around a little bit, but continues to be in an uptrend. Gold also seeing a little bit of weakness, but still in an uptrend. Silver also chopping around, but in an uptrend. The dollar had a down week, but we're still above previous support. You could almost make a case for a bottom head and shoulders pattern here, where you have a shoulder, the head, and a shoulder, if we can bounce up out of that. Looking at bonds and interest rates, the total bond ETF, even though we did decline, we're still in an overall uptrend. Looking at a daily chart of yields where they really spiked up on Wednesday and Thursday, and they turned down slightly on Friday. Looking at a weekly chart internationally, the UK has the highest rates, followed by the US, and then Germany. We're also keeping an eye on Japan, and for right now, that's their own little story, and if it starts to come to the forefront, I will be talking more about that. Stocks continue to outperform bonds on the monthly chart, and we're looking at the MOVE index, which measures volatility of bonds, where it really spiked up as bonds were going down and interest rates were going up. We saw a little bit of a move up with the VIX, And the correlation between the two is starting to get a lot stronger, meaning that they're having a tendency to go in the same direction at the same time. When we look at the 1 month yield and then subtract the 3 month yield, we're still getting a negative result, which is what we should be. So this is more normal. Our relative studies. Here's the intermarket analysis chart where we show that stocks are doing the best even though they're coming down slightly, followed by gold. And then we have the dollar, and then bonds are this blue line. And then what's negative, even though it's showing some improvement, continues to be oil. Then if we go back to the beginning of 2022, oil is still in the lead, followed by the dollar and gold, where bonds and stocks are underwater. The NASDAQ is outperforming the S&P 500. The S&P 100 continues to outperform the S&P 500. Growth is continuing to outperform value. We just saw a recent golden cross with this ratio. Gold, even though it's showing some weakness, continues to be in an uptrend compared to the S&P. Bonds continue to underperform the S&P, and gold continues to underperform the dollar. We came up to this downward sloping trend line, bounced down. We're trying to see if we can get back up and break through that. Energy has been really underperforming the tech sector. And low volatility stocks are really underperforming the S&P, where they outperformed in 2022. Discretionary is now doing better than staples, and we've seen a recent golden cross with this ratio. Some of our secular and cyclical trend studies. Secular means very long term, which could be many decades. Cyclical could be a few years. Where first of all, we look at the NYSE breadth thrust, where there was a signal generated back in October, and then we bounced up out of that. And this signal is still on the books almost indefinitely. And then we saw the ZWAG NYSE breadth thrust get generated last March, and then immediately go to this extreme reading. That's the signal. And this signal is still on the books indefinitely as well. We're looking at the NYSE Zohorchak method, where for 2022 and a lot of 2023, this was negative. And recently, this shot up to give us a buy signal, and that's also longer term until we see this signal come back down. Our momentum studies, when we go back to 1998 to 2004, it looked like we were breaking out above this trend line, but the MACD was still negative, so those breakouts ended up failing. We saw a failure back in 2007 to 2010. So right now, we broke out and we're still positive with the MACD and we're still above this trend line. And I'm going through this part of the video a lot faster now because the more we leave this behind us, the less relevant this becomes. So what's our outlook for the upcoming week? Here is the economic calendar for everything coming out. The big one is going to be CPI on Wednesday, PPI on Thursday. The Stock Traders Almanac statistics for Monday, July 10th. This only applies to Monday. We're neutral to positive across the board with the Dow, S&P, and NASDAQ. We will be on the 5th trading day of the month on Monday, where we do see some positive action, and then we see some choppiness as we go throughout July, and then it's about the middle of July when we possibly top out, and then historically anyway, tend to see some weakness going into the latter part of July. We're also keeping an eye on the NASDAQ. It tends to perform well into the middle part of July as well. So our scenarios, and this is just for Monday. We're not going with the down one yet unless we see a lot more weakness, and then our charts will suggest that we're turning more negative. So we're still defaulting to the positive trend, but beware, we are still somewhat overbought. We have seen some negative price action. If we start to break below support, it's going to negate this positive stance that we have right now. And we're not going with a neutral or sideways trend because our ADX is above 20. Even though it's declining below its moving average, the fact that it is above 20 suggests that we're still in a trend. The warning signs, and this is as of last Friday, and it's based on the daily charts. The VIX is still showing complacency. It's acting kind of strange, so there's another chart that I pull out to look at that we're trying to get some insight from. The cumulative new highs, new lows for the NASDAQ continue to show weakness. The 3-month yield is above the level where it was at back in 2007, and that's right before we had the great financial crisis. The growth part of the S&P 500, even though it's still in an uptrend, is starting to show some weakness, and that's a bit of a concern. And then we're starting to come back into earnings season again, which can be positive or negative depending on what company reports. What are the positive signs? We do have the seasonality and setups that I just talked about a moment ago. Those are still in the background. The daily special K chart is positive, where the weekly special K chart is negative. The long-term 253 period of the equity put-call ratio is going down, which that is actually positive. The S&P remains above a downtrend channel upper line. We're still far above that, so I haven't been showing that chart. we're still in a risk-on posture, which means folks are favoring stocks over bonds. The Dow transports are improving. They came right up to resistance, came back down on Thursday, and then tried to break through it on Friday, but haven't been able to do that yet. Will they be able to break more to the upside? That could give some good support to the market. Lower price levels so far have been providing support, but we'll be keeping an eye on those levels. The S&P is outperforming utilities. The NASDAQ, we're dealing with the 61.8% resistance level on the daily chart. We're also dealing on the NASDAQ 100 with a previous high. So far, neither one of these indexes have been able to break through that level. The Staples to S&P 500 ratio is declining, which often gives support to the S&P. We did see a golden cross with the Russell 2000 index, but we did not see that on the S&P small cap index, and the mid caps also generated a recent golden cross. Small and mid-cap growth continues to be positive, especially mid-cap growth. And then this is something from Tom Bowley, who sends out an email once a month. He just looks at July at a glance, where it tends to be a strong month, where tech tends to be hot and energy tends to not be very hot. We see a lot of our gains from July 1st through the 17th, where we have a 25.91% return during that time. Then we go into some weakness where we're down 13.85%. And then we pick it up again near the end of July, being up 21.07. And then he says at the bottom, going back the last 2 decades, the Qs have outperformed the S&P in 79% of the Julys and outperformed them by 1.1%. So thank you. I really hope you found this useful. Please feel free to check out some of the other videos that I post. I hope you have a very nice weekend, and I will talk to you in the next video.